My name is Jayani James. I am a Master's of Accounting student here at the University of Oregon, and I just recently finished my undergrad in accounting last year. So I was where you are or am where you are as a student currently. So I work with the Financial Wellness Center at the University of Oregon. And before we start our actual presentation, I wanted to tell you guys a little bit about our mission. So, who we are as a financial wellness team is just a group of individuals looking to give students the tools necessary for them to feel empowered in making financial decisions, both in college and in the future. And we work with the other institutions in the school, like the actual financial aid office, to put things like this together for students, as well as we keep peer counselors on deck at all times to help students as well. With that being said, let's start our presentation. So today I'm going to be talking to you guys about loan repayment and the journey to becoming debt-free, which is a pretty hot topic in today's day and age for students. So the key topics of today's presentation are basic loan types and terms, prepping for loan repayment, repayment options, loan forgiveness and cancellation, as well as COVID-19's impact on student loans. And after this presentation, you should know about at least all of these things and hopefully a little bit more. So to start off with student loan basics, if you are a University of Oregon student, which I'm going to assume that everyone here is, you can accept all your student loans on DuckWeb if you choose to take them out through the same people who give you your FAFSA, which is the government. And the loan will then pay towards your University of Oregon bill. The way that this works is it pays your tuition first, and anything that you have after that will pay out to your account in the form of a direct deposit or a refund check. And that refund can be used to pay for things like supplies or books. So once you have that loan paid out, you don't technically have to make any payments until after you graduate. However, for certain loans, there will be accruing interest from the moment it's taken out. And I'll mention those loans in a second. So while you're in school, you don't have to pay for your loan, but once you graduate, a grace period will begin. And this grace period is how long you have until you have to start making mandatory payments. And that's when the repayment begins. So now that you know a little bit of basics about student loans, let's talk about the types of federal student loans. There are 4. There's a direct subsidized and a direct unsubsidized loan, a grad plus or parent plus loan, and a Perkins loan. The Perkins loan is no longer available for students, so we won't really go into depth on that one, but the direct subsidized loan, to start off with, is only offered to undergrad students, and it doesn't accrue interest at all while you're in school. The interest starts upon your repayment, and remember that you have a 6-month grace period for this one. So your repayment starts whenever you choose, as long as it aligns with that 6-month grace period. And then you have your direct unsubsidized loan. This is available to both graduate and undergraduate students. It does accrue interest while you're in school, however. So as soon as that loan pays out, you're going to start accruing interest on it that you'll be responsible for paying. However, you don't have to pay it. Again, I reiterate, you don't have to pay it until after you graduate and have used up your 6-month grace period. Okay, so for graduate students and parents, there's something called a PLUS loan. If you are a graduate student, you are completely responsible for taking this loan out. This loan does accrue interest while you're in school, like the unsubsidized loan. It's just a larger lump sum amount. So the Parent Plus loan, the only difference there is that the parent is going to be paying it back and not the student. And the Graduate Plus loan, the graduate student is responsible for paying back the full amount of that loan, including interest after their grace period. The Perkins loan, if any of you do still happen to have it, was a great loan because it didn't have any interest while you were in school and it had a grace period of 9 months. However, it's no longer offered. It's important to note that your grace period begins when you drop below half-time enrollment. And with that being said, we'll move on to the next part of the presentation. So now we're going to talk a little bit about prepping for loan payment, or what you're going to do after you've taken out whatever loan you chose out of the 4 we just talked about. So there's a process, and then there's a breakdown of the process. The process is to firstly find your loan servicer and create an account with them. And then you want to determine how much you owe and estimate monthly payments, and then complete exit counseling. So if you've taken out a loan via federal loans, then you can complete the steps 1 through 4 on studentaid.gov, which is really convenient. We recommend that students actually keep track of how much they owe during their time in school, so they aren't shocked by it or taking out more than they think they can afford to take out. You can also do a simulation on that same website, studentaid.gov, that will allow you to estimate your monthly payments based on an income and things of the sort. Now, if you happen to have a Perkins loan lingering around, your loan servicer is actually ECSI, and they can be contacted via https://efpls.ed.gov. Okay, so once you've figured out who your loan servicer is, you're going to start wanting to discuss something called a repayment plan with them. First, let's talk about traditional repayment plans. There are 3: the standard, graduated, and extended payment plans. So the standard payment plan is just a fixed amount that you pay every month for 10 years. And then the graduated payment plan has lower payments at first every month, and then the payment amount increases every 2 years until that loan is paid off in a 10-year repayment term. And then the last type of traditional repayment plan option is an extended option. So this is only available if you've taken out $30,000 or more in loans. So it's a pretty generous amount of loans that would need to be taken out. And the payments are the same as graduated, or they can be fixed as well if you decide to do like a standard payment plan. Just the extension is just that it takes now up to 25 years instead of 10 years to repay. And you do have the option to switch between any 3 of these repayment plan options at any time, and you can earn a interest rate reduction of 0.25% if you decide to do something called auto payments, which is just setting it up to come out of your account automatically once. So now that we talked about basic repayment plan options, there's also something called income-driven repayment plans. These repayment plans let you base how much you're paying on how much you're making. The first 2 we're going to talk about are the payee and the repayee. So pay as you earn versus revised pay as you earn. And for pay as you earn, this is available to people who borrowed after October 1st, 2007. And if you're here, I'm going to assume that was you. The payments are based on your family income and your family size. And what you're looking at here is 10% of your discretionary income, which if you go to studentaid.gov, they can help you to figure that out as well. And then this also looks to see if you're married filing joint. So it looks at your spouse's eligible student loan debt, as well as their aggregate gross income, to see what you should actually be paying. The revised pay as you earn is virtually the same. The only difference here is that it's not only for borrowers who borrowed after October 1st, 2007, but the payments are still based on the family size and the amount of debt that you had. The next 2 income-driven repayment plans are income-based repayment and income-contingent repayment. So income-based repayment are payments based on your income, family size, and your student loan debt. However, this one is going to be 15% of your discretionary income is what you're looking at paying versus the 10% that we had in the last 2. However, if you borrowed after July 1st, 2014, the 10% is still available to you with this type of loan. This one also looks at your spouse's aggregate gross income as well as their eligible student loan debt. to see how much you should be paying. And then there's income contingent, repayment. And these payments, again, are based on your income and family size. But this one is going to be 20% of your discretionary income. And it does look at your married filing jointly spouse's debt as well as their aggregate gross income as well. If aggregate gross income kind of sounds foreign, that's just the amount of income that you made during the year. And these income-driven repayment plans offer taxable loan forgiveness after 20 to 25 years, which is always something nice to hear. Okay, so we talked about the basic type of loans and the basic type of loan repayments. So what do you do if you have several different loans from several different servicers at several different interest rates? It can all be very confusing and kind of hard to keep up with. So that's when we would recommend or introduce the idea of loan consolidation. And this is just simply taking your loans that you have, combining them into one lump sum loan, and then getting an aggregate or an average interest rate for that new principal or the new total amount of your loan and paying that once a month instead of paying several different servicers a certain amount once a month and making it harder to keep up with. So the benefits, if that wasn't clear, the benefits would be single monthly payments, a fixed interest rate, and expanded repayment options. The lower monthly payment benefit, it's only really an option to you if you have decided to elongate the term of your loan so that you're spending less money each month. Just in the long run, you will end up spending more money. So now that you know all of that, we're going to talk about kind of like cancellation of loans and how people are getting their loans forgiven today. So there's been a pandemic, as we all know. It's been very tiring and taxing on all of us, but we're here and we're fighting. So the one benefit that's come out of this pandemic for us students is something called the CARES Act, and it actually was affecting loans and what we had to pay. So until September 31st of this year, it may be extended, but right now that's what it is. We have a suspension of loan payments, a stopping of collections and defaulted loans, as well as 0% interest rate on any loan that was taken out prior to this pandemic. And this information is being updated at studentaid.gov whenever there is a new update. But as of now, there's 0% interest rate on loans until September 31st of this year. So a little bit more about cancellation. So we have loan forgiveness and cancellation for public service employees. And these are people who work a full-time public service job and actually took the time to enroll in an income-driven repayment plan. That's important to note. So these next couple of cancelations and forgiveness services you have to enroll in. Your loan servicer is not going to assume that just because you signed up for this loan, you don't want to pay for it. They're going to try to get as much money out of you as they can. So make sure that you look for these type of things as soon as you're starting the process of repaying your loans. But anyway, to qualify for this specific cancellation, you have to have direct loans, which does not include Perkins, which luckily for you guys no longer exists, I guess, in this case. So in order to qualify, you have to make 120 on-time monthly payments, and the remaining student loan balance up after that point will be forgiven, and it is tax exempt, meaning you don't have to pay tax dollars on the money that you used in college once this is forgiven. So a little bit more on the certificate you have to complete. It's called a PSLF certificate and application, and you can find it at myfedloan.org. And again, this is for public service jobs. But there is another type of loan forgiveness and cancellation for teachers, actually. So anyone who teaches full-time for 5 complete or consecutive academic years in a low-income elementary or secondary school can qualify for this form of loan forgiveness. So if you had a subsidized or unsubsidized loan only, This is not for Parent Plus loans, Graduate Plus loans, or Perkins loans. And then we can forgive up to $5,000 if you're an elementary or secondary teacher. And then if you're a secondary math or science or some other form of special education teacher, you can get up to $17,500 forgiven from your student debt. And then to find out more about this specific type of loan forgiveness, you want to go to studentaid.gov so you can make sure that you meet the requirements. Okay, for our final type of loan cancellation, we're going to talk about Perkins loans. And I know some of you may not be familiar with this, but just in case you have this loan or are trying to pay it off, you have to be serving full-time in a certain occupation, which leaves a lot to the imagination. But some examples of this are nurse, military, or teacher. The rest of it can be found at ba.uoregon.edu to figure out what type of job qualifies for this cancellation. And then up to 100% of this loan can be canceled if you qualify, but the amounts vary per occupation and may be provided in increments as opposed to the full amount up front. So to find out more about this loan cancellation, you want to contact UO Business Affairs office. Their phone number is listed on the screen, but their website is ba.uoregon.edu for more information on Perkins loan cancellation. Okay, so we've kind of run through everything. We've talked about the basics. We've talked about your repayment plans and cancellation and consolidation. So now we're wrapping up and we're just gonna do some tips and resources for you guys. So if you can't make your payments or you're struggling to make a payment because our current economy, we're in the middle of a pandemic or something else has happened, you want to contact your loan servicer. Once you get in contact with them, you can talk about either reducing your payments amount or moving the payment date to a later date so that you can try to make that payment later. Another tip that we have for you guys is to be cautious of phone calls, emails, letters, and texts offering you loan relief because like I mentioned, your loan servicer, they want to make as much money as they can. So they're probably not going to come to you offering you any type of relief. If they do, call them to make sure and make sure you're the one actually starting the phone call as opposed to receiving it to avoid scams. And then my last tip is if you guys pay more than $600 in student loan interest yearly, then you can deduct that on your taxes up to $2,500 if you decide not to take what is called a standard deduction. And then if any of that didn't make sense or you have any questions that need to be answered, please let me know now. So to start consolidating your loans, someone asked where you would go to start consolidating your loans. You want to talk to your loan servicer, which you can find at studentaid.gov if you have a federal loan. And if you don't, you can get in contact with them either via the website you took out the loan on or the phone number they provided with